Scott and I wrote a white paper. It's gotten good. We got about, I don't know, about 1,000 advisors that picked it up. And it was really written for financial advisors. I did a synopsis in the newsletter. It's a 20-pager, but I cut it down. I don't know if people read it. But if you want to read the whole thing, go to my website. It's pretty deep. But anyway, I start the article by saying that I start talking about this is the most popular mix in financial planning. 98% of pensions, endowments, individuals, 60% stock, 40% bonds. It was developed by Dr. Markowitz in 1952 based on 10 years of regression work. And he won the Nobel Prize in 1990 for this. They call it modern portfolio theory. And of course, that's a 1952 Chevy. That's pretty modern. So I really kind of talk a lot in the first part of the paper about how the 60-40 has been tried and true over so many years. Now, the concept is a good concept, and it makes sense. If you were to talk to everybody in this restaurant and said, so how are you protecting your money? I think to a person they would say, well, I'm diversified and I have a good asset allocation model. That's 99% of the world, and I get that. I understand that. And their argument is a valid one. If one asset's doing bad, another asset's doing well, and that diversification can protect savings, and bonds is a great source of income. But now bonds are paying nothing. They're paying zero. Ray Dalio's, the big famous hedge fund manager, says, don't own bonds, don't own cash. Morningstar basically said, you'd be an idiot to own bonds today because they're zero, and after inflation, they're negative. Basically, they're saying that 60-40 is an accident waiting to happen. That's what this article says in Bloomberg. Warren Buffett never believed in diversification. You guys have heard me talk for a long, long time, and I said the problem with diversification is as well diversified as you are, whether you have 10 stocks or whether you have 100 different positions, when markets become volatile, everything tends to crash. China, Japan, US, we saw that in the COVID crisis. In fact, what's interesting is, if you look at the COVID crisis, the market was down 34.4%. The 60-40 had its worst performance since World War II. Why? Because bonds did not, they lost 20%. Bonds did not hedge at all. In fact, bonds, this is the 10-year, this is the 20-year, and this is the Barclay Ag, which is a combination of corporates and treasuries. So you can see that the bonds gave no diversification, zero diversification. And that's how the world still acts. I mean, I get a lot of call from advisors, and they say, well, I say, do you think there could be higher inflation? They say, probably, yeah. I said, okay, do you think interest rates are going up? They say, yeah, I think interest rates are going up. I said, okay, do you realize that if there's a 2% rise in interest rates and you're holding a 20-year or 10-year bond, and you have a client worth $1 million and he has $400,000, 40% in debt, that part of the portfolio is going to lose 23%. So this is a 2% change in interest rates on a 10 or 20-year bond. That's a big loss. And so a lot of financial professionals are they don't know what to do.